Hello everybody, welcome to another episode of Erickson TV. Curtis here with Lauren. Hey Lauren.
Hey everybody.
Hey Lauren, I thought we would talk about something that was in the newspaper today. It's the USA Today newspaper, and they have I'm not expecting the camera to see this, but they have an article called "The Bull Market Turns 3," or what they mean is 3 years old.
3 years old, okay, yeah.
So what they mean there is that on the last terrible stock market, bear market that started in the fall of 2008, that ended on March of 2009.
Right.
The bottom hit.
Yeah.
And from then we've had a significant swing in the indexes. So the way they start the article is, first of all, they kind of make it look like it's on fire. So it might be like it's almost like pessimistic, but the thing
is the end near?
Yeah, is the end near. The interesting thing is the market has gone up from that bottom. They're using the Dow Jones, or actually they're using the S&P 500. The U.S. stock market's gone up about 103% since that bottom of 3 years ago. Okay.
All right.
So the interesting thing is they start talking about the 5 things that could derail the bull market. Number 1 is, and we're feeling it today if you're driving a car, the gas price shock. Number 2 is dysfunctional U.S. politics.
Okay.
Number 3 is interest rate fears and the fear of inflation.
Okay.
Number 4 is economic slowdown in China.
Okay.
And then the one that you keep hearing on the news almost every other day is European debt woes resurface, according with Greece and everything like that.
Yeah.
I thought, you know, then in the very, very small print they say, optimists still outnumber pessimists. But those are the 5 things that could kill the market. The thing I took from this is it was interesting. They put a chart of the previous bull markets and how long they lasted.
Okay.
The one that I always kind of go back to, and I kind of study this period pretty significantly, the bull market of the bull market that started after the stock market crash in 73, 74.
Right.
That one was interesting. The actual bull market continued on for 73.9 months. So more than double of what this one's done so far.
Oh, okay.
And it went up about 126%. But the interesting thing is they go through the other bull markets after the bottoms were hit, all the way back to the Great Depression. And the interesting thing is, if you look at every one of the bull markets, the average time frame in months of how long the bull market lasted before a significant downturn occurred again was 55.2 months.
Okay.
So I don't know what that means mathematically, because just because it happened before mathematically doesn't mean it's going to happen again. But what do you take away from this article?
Well, yeah, okay, so the average bull market was about 4 years or so, yes? Yeah. Well, bulls and bears is a properly understood subject for zoology. But I think that, the thing about the article is, okay, they got 5 things that could derail a bull market. Okay, in any investing environment, I can come up with 5 things that can make things go well, and I can come up with 5 things that will make things go badly. And in particular, what's odd about that article is all 5 of those things are things that everybody knows.
Right, it's already built into the price.
Right. Nobody
There's no surprises.
Right, nobody is unaware that gas prices have gone up. Nobody is unaware that interest rates are very low and could go up again. I don't know why inflation would necessarily do anything one way or the other to the stock market. It would do something to bonds, but not the stocks. So some of the things they say I don't even quite know. China's economy might slow down. For 20 years, China's economy might slow down.
Right.
We've been hearing this story forever and ever. So it's all the kind of the same stuff. And then as far as the average length of when the markets tend to go up, well, that average is interesting, but the distance around the average is what's really interesting. I mean, you can have a bull market that's very short, and then you can have bull markets that last for years and years and years, and there's no way of knowing in beforehand how long each is going to be. I think that there's one losing year for about every 3 or 4 winning years. Right. So the fact that the average bull market is about 4 years is kind of makes sense. Yeah, it kind of makes sense.
Well, my takeaway is, as we finish this episode, is without even trying to predict what's going to happen tomorrow in the stock market, which we don't do, the interesting thing to me is this bull market that's been going on for 3 years now, as of this week, has happened while there's been net outflows to equity funds. So that the bull market has gone up, even though the average investor has pulled money out of stocks.
Made the mistake of thinking about all the things that can go wrong and that have gone wrong.
So that tells me a lot of people have missed this bull market.
Yes, they have.
And so the question is, based on based on everything that's knowable in today's information, is it too late for them to get back in if they're long-term investors?
No.
No, it's never too late to get back in if
it's
you're
not.
long-term investors.
But stay in this time.
Yeah. All right. That's our takeaway. It's staying this time. For our clients that have been disciplined investors, you have stayed in and you have participated in this recovery. If you felt like that because of the emotions that you were one of those investors that missed it, you should probably contact Laura and I and give some analysis of your current portfolio and retirement plans. Thank you very much for watching this episode of Erickson TV. We'll see you next time.
See you next time.